The Internal Revenue Service has provided an overview of some of the key tax provisions in the American Rescue Plan Act. Hello, my name is Nikki Young and I'm an enrolled agent with Latino Tax Pro. We're an association dedicated to serving the needs of the Latino community through tax preparation training in both English and Spanish. 2021 tax season is near the end. We thought 2020 couldn't get any crazier. Welcome to 2021. We already are seeing current tax year changes that will affect millions of people. Here is Form 1099-G, which is used to report unemployment compensation. A few years back, I was on unemployment for a few weeks, and the form to apply for unemployment had a series of questions, the very last one being if I wanted to have federal taxes withheld. Very easy to miss. Do you know how many of my clients I have asked if they were having taxes withheld on their unemployment claims, and they had a shocked look on their face. "You mean I have to pay taxes?" they asked. I nodded yes. To my amazement, they mostly shrugged their shoulders and said, "Oh well, maybe they'll make it non-taxable because of COVID-19. Guess what? They did. Well, at least $10,200 of it. For tax year 2020 only, the first $10,200 of unemployment compensation is not taxable for most households. Of course, they say 2020 only, but I'll bet it's going to be extended. This tax benefit is only available to those whose modified adjusted gross income is below $150,000 during 2020. The same income cap applies to all filing statuses. For couples where both spouses received unemployment compensation, each spouse can subtract $10,200. For any eligible taxpayer who has already filed and reported their compensation as fully taxable, the IRS is automatically adjusting their return and providing them this tax benefit. Refunds based on this adjustment are being issued in May and continuing through the summer. So don't file an amendment. Taxpayers who purchased health insurance through a federal or state health insurance marketplace won't report an excess repayment or attach Form 8962 premium tax credit when they file. Taxpayers use Form 8962 to figure the amount of the premium tax credit they're entitled to receive and reconcile it with any advance premium tax credit they receive through the marketplace. If the advance payment was too little, they claim a net premium tax credit. The process remains unchanged for taxpayers claiming a net premium tax credit for 2020. They must file Form 8962 when they file their 2020 tax return. However, if the advance payment was higher than their allowable premium tax credit, they need to pay back the difference, known as the excess advance premium tax credit. The new law suspends the repayment requirement for 2020. This means that affected taxpayers do not need to report excess advance premium tax credit or file Form 8962. The IRS will automatically reduce the repayment amount to zero. In addition, the agency will automatically reimburse anyone who has already repaid their 2020 excess advance premium tax credit. Also, just a note, be sure to check for your individual state to see if they also will do this. Unfortunately, I know in California, they are not doing that. So looking ahead to 2021 tax year, the new law increases the amount of the credit and eligible expenses for child and dependent care. It modifies the phase out of the credit for higher earners and makes it completely refundable. For 2021, the top credit percentage of qualifying expenses increased from 35% to 50%. In addition, eligible taxpayers can claim qualifying child and dependent care expenses up to $8,000 for one qualifying child or dependent, up from $3,000 in prior years, or $16,000 for two or more qualifying dependents, up from $6,000 before 2021. Also for 2021 only, more childless workers and couples can qualify for the earned income tax credit because the maximum credit is nearly tripled for these taxpayers and is for the first time made available to both younger workers and senior citizens. In 2021, the maximum EITC for those with no dependents is $1,502, up from $538 in 2020. Available to filers with an AGI below $27,300 in 2021, it can be claimed by eligible workers who are at least 19 years of age, not 25 anymore. There are some additional changes made to the EITC. Singles and couples who have Social Security numbers can claim the credit even if their children don't have SSNs. In this instance, they would get the smaller credit available to childless workers. In the past, these filers didn't qualify for the credit. More workers and working families who also have investment income can get the credit. Starting in 2021, the limit on investment income is increased to $10,000. After 2021, the $10,000 limit is indexed for inflation. The current limit is only $3,650. Also, married but separated spouses can choose to be treated as not married for EITC purposes. First time. To qualify, the spouse claiming the credit cannot file jointly with the other spouse, cannot have the same principal residence as the other spouse for at least 6 months out of the year, and must have a qualifying child living with them for more than half of the year. Also, special look back for EITC and child tax credit. The bill includes a special temporary rule allowing lower income individuals to use their earned income from tax year 2019 to determine the earned income tax credit and the refundable portion of the child tax credit. For example, the additional child tax credit in the 2021 tax year. This will help workers who experienced lower wages this year due to the pandemic to get a larger refund that is consistent with their earnings from prior filing seasons. The IRS now has to figure out how to include this in the 1040. Their 2021 income must be lower than their 2019 income. The new law increases the amount of the child tax credit, makes it available for 17-year-old dependents, makes it fully refundable, and makes it possible for families to receive up to half of it in advance during the last half of 2021. Moreover, families can get the credit even if they have little or no income from a job, business, or other source. Currently, the credit is worth up to $2,000 per eligible child. The new law increases it to as much as $3,000 per child for dependents ages 6 through 17 and $3,600 for dependents ages 5 and under. The maximum credit is available to taxpayers with a modified AGI of $75,000 or less for singles, $112,500 or less for head of household, and $150,000 or less for married couples filing a joint return and qualifying widow and widowers. Above these income thresholds, the extra amount above the original $2,000 credit, either $1,000 or $1,600 per child, is reduced by $50 for every $1,000 in modified AGI. Don't forget, the original $2,000, your AGI could be up to $400,000. Also, the credit is fully refundable for 2021. Before this year, the refundable portion was limited to $1,400 per child. Also, advanced child tax credit payments from July through December of 2021, up to half the credit will be advanced to eligible families by Treasury and the IRS. The advance payments will be estimated from their 2020 return, and if not available, their 2019 return. In the next few weeks, eligible families can choose to decline receiving the advance payments Likewise, families will also be able to notify Treasury and the IRS of changes in their income, filing status, or number of qualifying children. Details will be available soon. We don't have them yet. So, for your dependents under 6 years of age, you will receive $300 per month. And for those 6 through 17, you will get $250 per month beginning in July. We're waiting to see how people can decline the advance payments and just get all of it when they file their 2021 taxes next year. Whew. So thank you for your attendance and attention. We hope you found this presentation beneficial. If you want to see more topics in the future, be sure to like and subscribe. We'd love to have you visit our website at latinotaxpro.org or call us at the number shown on the screen. Until next time.